Where can the market go next after this remarkable rally over the past month? Even though the economic backdrop feels much more encouraging than it did at the end of October, with inflation shrinking and interest rates steadily going lower, we're still in a bit of an uncertain market. I mean, think about it. It looks like we're headed for an extremely soft landing, but we can't be sure. It looks like the Fed might be done tightening. We're certainly getting a lot of chatter from Fed heads about that. But maybe they decide, well, hey, we need one more hike or two to whip inflation down. Rather than trying to make a subjective assessment of where we are right now, something that's easily influenced by your emotions, you know what we ought to do? How about we take a quantitative approach to evaluating this thing? That's why tonight we're going off the charts with the help of Carolyn. She's that brilliant technician who runs a trading room at ElliottWaveTrader.net and whose work you can find on X, formerly Twitter, at Queen of Fibs. So what does Broden see here? Let's start with a weekly chart of the S&P 500. Now, you know we've seen a beautiful rally from the lows a little over a month ago, but she believes that the S&P actually has more room to run. Why? Basically, as Broden sees it, the S&P 500 bottomed in late October, and we can see this was one of those that surprised people that it didn't go lower, okay? As long as it stays above these lows right here, then she thinks the natural course will be to go higher, maybe substantially higher. Remember her methodology. She measures past swings in a given security, then runs those swings through what's known as the prism of Fibonacci numbers. That's a series of ratios that repeat over and over again in nature. Now, you can find them in patterns on snail shells, flowers. That's flowers, actual patterns. And for some bizarre reason, they also show up at key moments in the stock market. I have absolutely no idea how that is, why something discovered by a medieval mathematician can help us predict line action in the market. But that's how I feel about all technical analysis. What matters is that it has a proven track record of working. And Fibonacci numbers work. In this case, Broden's Fibonacci forecast finds key levels at 127.2% and 161.8% extensions of the previous move, the decline from the peak in July to the lows in October. Those Fibonacci extensions give her a pair of price targets for the S&P 500. Now, one of them is 4,743, another is 4,918. Given that the S&P currently resides in the 4,500 level, these represent some meaningful moves. Of course, Broden cautions that these Fibonacci price targets are never guaranteed. It's not like her method works 100% of the time. Nothing does. But she says they're worth shooting for because the targets end up being met surprisingly often, and I can verify for that totally. Now, even though she has these key upside targets, Broden's not assuming the S&P will go up in a straight line. This is really important because it's what I've been talking about with the morning meetings for the club. We're flopping and chopping. As a matter of fact, when she looks at the S&P 500 daily chart, she sees the possibility of some near-term turbulence. Why? Because her Fibonacci method doesn't just apply to the price, the y-axis of the chart, it also applies to time, the x-axis. She can measure the duration of past swings, run them through the same Fibonacci rubric, and find key dates where the index is likely to change course, even if it's just temporary. And right now she's seeing a confluence, and that's what all this is about, confluence of Fibonacci timing cycles that come due this week, timing cycles that could act as resistance to the current rally, those up there. Now, this is going to go through Thursday that we're going to be stuck like this. There are a bunch of these timing cycles that are kicking in right now. Given that the S&P's been roaring lately, if we get a trend reversal, that means we might be looking at a pullback here. Maybe not that much, but that will mean something to most people. However, if the S&P does sell off this week, Broden says you want to watch for potential entry points because we're still very much in bull market mode. The chart makes a healthy pattern here, and crucially, the moving averages are on the side not of the bears, but of the bulls. Broden notes that the S&P currently trading above both its 250-day simple moving average, so we're looking at this and this. It's trading above those, that's this and this, all right? That is always a good sign in chart world. At the same time, she likes to watch the 5-day exponential moving average and the 13-day exponential moving average for potential buy and sell triggers when the 5-day is above the 13-day. Okay, so when you see this line above that, now that's bullish, and that's where we are. That's my absolute favorite because I always love to see that. That shows that's the innate strength of this market is right there in that line. Now, as long as these conditions remain the same, Broden recommends buying the pullbacks. I agree. So for the moment, she remains what she calls herself a cautious bull. Bullish because the chart still looks good, but cautious because we've had such a huge run when you look at the timing. She thinks we might be due for a temporary garden variety pullback. Now, within this market, Broden's also spotted some quality opportunities, and she wanted to highlight one in particular for us, okay? She likes what she sees in the daily chart of world favorite Tesla. I thought you don't like this. Tesla's the most asked about stock. She saw its stock get crushed, we know, July and October, but has rebounded nicely from its lows. Now here we're looking at what's known as a two-step pattern. This is a zigzag pattern with some specific Fibonacci ratios that Broden likes to look for. One of the main elements of the two-step pattern is that the first swing is similar to the second swing. Similar meaning amount of dollars, price. With Tesla, the first major swing down from July through August took the stock down by $86.93. Okay, there. The second swing from September high to the October low took Tesla down to $84.91. So $84.91, pretty close to 86, right? That's what you need to pay attention to. In short, we had two declines separated by a brief bounce, and they were roughly equal in absolute size. With Tesla, the actual two-step pattern support zone came in between 192 and 194. Okay, that's the support zone. So that's where we looking for a floor. That's where Broden's Fibonacci method says likely to bottom based on a series of key price levels. Sure enough, what did it do? It bottomed at 194 on October 31st. Boom, she nailed it entirely. So far, Tesla's rallied roughly 53 bucks off this low to 246 and change. But if Broden's right about the two-step pattern, then she expects the stock to keep running and running and running all the way to the 327 to 328 area. That represents 127.2% extension of the full zigzag pattern, and it's where she often sees stocks going when we see this particular formation, okay? However, before we can get there, Tesla needs to clear some important hurdles. There's a resistance hurdle right around where it's currently trading from 246 to 252, another hurdle around 259 to 260, so you can see where these are hurdle lines that you got to get above before it can go all the way. If the stock can't clear those hurdles, then Broden thinks you should throw in the towel, because it means the stock's vulnerable to another harsh decline. However, she thinks it's more than likely that Tesla keeps heading higher. I agree. Here's the bottom line. The charts interpreted by Carolyn Broden suggest that the S&P 500 might be in for some short-term turbulence, but she expects it to keep climbing, buying opportunity. At the same time, she thinks that Tesla's got more room to run, especially if we can break through its current ceiling of resistance. I hope she's right, but I like the fact that it sounds like the market will be working off that critical overbought position that I don't like without doing a lot of technical damage or damage to your portfolio. Let's take calls. Let's go to Jim in New Jersey. Jim.
Yes.